one of my pet sayings is that ESOPs are the best kept secret in the tax code. I hope someday, I can't say that. In other words, I hope someday they're more well known and well appreciated, but that's where we are today.
Great. Well, thank you for that. So Rick is joining us from ESOP Plus. He's here to help us kind of demystify ESOPs, what they are, what you may have heard, why it is or isn't true. Thank you for joining Touchstone Talks today.
It's my pleasure to be here.
Great. So pretend I know nothing about ESOPs. Right. Give me like the elevator pitch. What's an ESOP?
I was going to use those same words myself. Little quick elevator pitch. I think it's worth going back, unfortunately, because it is a long time ago and I'm still talking, that they're not as well known as maybe they should be, at least in my opinion. But let's go back to the 1960s and early 1970s. The general thoughts back then, and you might agree with me, those same thoughts are still evident today, was that the average American worker did not put away enough money for retirement.
That might still be true.
They were saying that, believe it or not, more than 50 years ago. Maybe still true today. I would say it might be. In addition, wealth concentration is at the ownership level of the business, not at the worker level, no matter how much you make per hour. Believe it or not, they were talking about wealth concentration, the concentration of money in this country at the ownership level, not at the worker level. And they came up with this concept. Actually, it was a gentleman named Louis Kelso, came up with a concept of sharing the wealth of the business through a retirement plan for the employees, so that it is a retirement plan, not a short-term bonus plan, but through a retirement plan, if we could share the wealth of the business with the employees, we'd be sharing wealth, taking away from concentration, adding to retirement savings, and hopefully creating maybe even a better company and a better economy. And believe it or not, they were saying that over 50 years ago. You might say we still have some of those problems here in our economy today. So when Washington wants us to do something, when our legislators in Washington want us to move in a direction, want to incent us to do something, what do? What is their main tool? I don't care whether it's charitable contributions, investing in your business, buying a house. The main tool our legislature in Washington has is tax benefits, tax credits. Mm-hmm. So when ERISA was adopted, 1974, we're talking 51 years ago now, in ERISA, they actually inserted tax benefits relating to a retirement plan focused on the value of the business. And that's really what an ESOP is. So for over 50 years, Congress has been saying, and many people believe it's appropriate, maybe just not enough yet, that the best way to share the wealth, or a good way to share the wealth, a good alternative for selling your business and getting a fair price and getting tax benefits, would be to sell your business, a privately held business, to an ESOP, to a benefit plan, a retirement plan for the benefit of all of the employees. And that's really what an ESOP is. At the beginning of the ESOP transaction, it's a liquidity event. It's a sale of the business, a sale of some or all of the equity of the business. Just like any business owner might wish, he or she may come a time in their career, come a time in the evolution of the business where it's time for them to get liquidity for the ownership in their business. And I think we all know, and I didn't create the saying, the silver tsunami. We are living through the silver tsunami, the baby boomer generation with hair the color of mine, who own businesses, who are looking to get liquidity, whether they're ready to exit or not. but they're looking to get liquidity. So at the beginning of the day, the ESOP transaction is that liquidity event for the owner of the business. At the end of the transaction, you've created a retirement program for your employees based upon the value of the business, based upon the value of the stock, the equity of the company these people work for, the employees work for. And if you're willing to do that, and it's not right, I'll be the first one to say it's not right in every situation, but I do believe every time, and I mean this very seriously, every time a liquidity event is being considered, the ESOP alternative, and notice I said it's just one of the alternatives, but I say the ESOP alternative should be considered. And to incent business owners to think about the ESOP alternative, to incent companies to take on the cost of putting in now a new retirement plan for their employees, maybe in addition to a 401k plan that they may already have. To incent the company, to incent the business owner, wonderful tax benefits have been provided. There are potential tax benefits for the seller. There are potential tax benefits for the company. And like I said before, there is a movement for employee ownership that's started 51 years ago. As we get into our discussion, I think I can share with you some thoughts on the speed, on the acceleration that we're seeing finally today in employee ownership. So hopefully that gives you a little bit of a teaser on what an ESOP
Yeah.
is and truthfully why we have them.
Well, let me do a quick recap to make sure I understand. So, if I'm an owner and I'm sitting here and I'm listening, this is an opportunity for me to consider a different way to exit my business where I can essentially sell it to an employee-owned program.
Yes, you're selling it actually to a benefit plan trust, to a retirement plan trust for the benefit of your employees.
So, but I still get to take my money out of the company, right? That's the liquidity event part.
Right. You are selling your shares. I think we all know there are different ways for owners of businesses to get liquidity for their shares. Certainly, private equity is one of the big alternatives today. You open up a newspaper, and certainly the business section of a newspaper, and there's probably a story about private equity. A competitor might want to buy your business. An investor may want to buy your business. There are dividend recapitalizations. There's a bunch of alternatives. And that's why I say the ESOP is just one of those alternatives.
Right.
But yes, the ESOP alternative is a way to get liquidity. You are selling your shares to the trust for the benefit of the employees.
Great. So talk to me for a minute because I can hear the thoughts of the listeners. Talk to me a minute about the tax advantage of doing that, the why this might actually work out better for me in the end.
So I will say, and you might get a different opinion from different lawyers that are involved in ESOPs, that the tax benefits should be an incentive to think about the ESOP, but it really shouldn't drive the transaction. However, when I say that, it also may be that extra little bit that pushes an owner in one direction or another. But the two principal tax benefits are one to the seller. The seller is permitted, if certain requirements are met, to sell his or her shares to the ESOP and defer. I have to say legally defer, but defer potentially forever. So that's a long deferral.
Long deferment.
Defer potentially forever the capital gains tax. So I think we all know today capital gains tax on the federal level, if for an owner of a business that's selling his or her shares, is 20%. Depends what state you're in. So I just use 25% as a round number. But if you sell your business to private equity or you sell your business to a competitor, let's just use a number, $10 million, and you had to pay 25% capital gains tax, the owner of that business has paid tax up to the extent of 25% of the $10 million. He or she walks away after tax. with $7.5 million. And there are strings attached, it's not purely just saying pressing a button, but with the
Tax laws always have strings. We all know that.
Exactly. We all know the tax code is maybe one of the more complicated books ever written. But if you sell those same shares, that same $10 million worth of shares to the ESOP and meet the requirements, you can walk away with $10 million. And structured properly, requirements met, nobody ever pays tax, capital gains tax, on that $10 million sale. So not only is the owner of the business getting more money up front, but that money that would have gone to taxes is also available to be invested or used. So you get a sort of a double return on the tax savings. So that's the basic tax program or tax savings for the owner of the business or the former owner of the business. The company also, and it does change a little bit whether you're a C Corp for taxes or an S Corp for tax purposes.
Right.
But the company will get a tax deduction for just because it created an ESOP with no money leaving the company. To me, that's the best tax deduction there is, because even a depreciation deduction, you had to make that investment. You had to buy
make
something.
The purchase.
Cash had to leave the company. Mm-hmm. Just because you've done an ESOP, you will get a tax deduction every year for many, many years, up to the extreme case. And this is where, especially when I'm talking to CPAs, I like to use the word nirvana. I say the word nirvana is in the tax code. And most CPAs hopefully will get a little bit of a chuckle out of that, because most people might say that the word nirvana, how could the word nirvana ever be in our tax code? But if you take an S corporation that's 100% ESOP owned, and I would say approximately 60 to 70% of the ESOPs done today are S corporations going 100% ESOP.
Okay.
Then, as we all know, in an S corporation, for tax purposes, the company's a pass-through entity. Tax liability flows through the owner.
Correct.
If the owner is an ESOP trusts are retirement plans. Retirement plans don't pay taxes. So that company provides a K-1 that used to provide that K-1 to the owner or owners of the business, the individuals that own the business. Now, if it is sold 100% to an ESOP, it still provides that K-1, but it sends the K-1 to the ESOP, to the trust. That trust doesn't file a tax return. The trust doesn't pay taxes. In effect, that K-1 gets thrown in the trash basket.
Right.
Nobody pays tax on the company. So you take that company maybe with a value of 10 million. So let's just say it has EBITDA, earnings before interest, taxes, et cetera, of $2 million. So maybe it sells for 5 times EBITDA. That's how we got to the 10 million. That $2 million of income that would have probably been taxed at 40% or so, right, if it went to an individual, that $2 million goes totally untaxed on a federal level, and in most states on a state level. There are some taxes I always have to, as a lawyer, have to be careful. Massachusetts, for example, has a 2.9% or 2.95% tax on S corporations that you can't get away from, but 2.9% is a lot less than 30 or 40%.
Yes, correct. I'm like, that's a reduction from 40 by quite a lot.
And in most states, let's take Connecticut. I know you're sitting in Connecticut today. Mm-hmm. Connecticut, you basically do away with state income tax and, of course, federal income tax. So that $2 million of taxable income doesn't go to the ESOP, doesn't go to the shareholder, stays with the company, right, for the best corporate uses that the board of directors figures that money should go and be used for.
Right. So now the company has $2 million to expand, increase marketing, whatever, pay off loans, whatever they need it to do.
Exactly.
Whatever they need.
Yeah.
So that's an advantage.
Those are pretty big tax incentives to get somebody to at least think about the ESOP alternative.
I hear that. Those are the arguments when we put in a lot of our, we look at exit planning, right? We put in the options, we put in the ESOP, and I keep hearing my accountant doesn't like it, my attorney doesn't like it. They say I'll never get my money out. So that's not what you're saying. So tell me, where does that myth come from? What's the concern?
I wish I had a real strong answer for that. I will tell you, I've been answering that question for over 20 years that I've been in the ESOP world. So it's not a new question. They're still out there. I think they are finally being minimized to some extent, but I'll be the first one to say those questions are still there. I think some of it goes back in the 80s. And so we're talking 40 years ago. There was a whole series of ESOPs that were done for troubled companies, and people were using them maybe as a way to get a troubled company, save it for the employees, get it out of its financial mess, and ESOPs were used. Um, in every industry, there are good and bad people putting transactions together. I hate to say it, but I don't care whether you're a doctor, a lawyer, a CPA, a plumber. There are good people in every industry and bad people in every industry. So some bad deals were put together that were misstructured, not properly understood. In addition, ESOPs, and finally this is changing, ESOPs were never part of the MBA curriculum. They were never part of the
Mm,
CPA curriculum and training. That is changing significantly. The Darden School of Business at University of Virginia just created a track in employee ownership with a focus on ESOPs. Rutgers,
okay.
the management school, the business school at Rutgers University. People have probably heard about Wharton at University of Pennsylvania. All three of these schools have programs in employee ownership with a focus on ESOPs. That's totally new. That wasn't there 10
Right.
or 15 years ago. And I think, unfortunately, a lot of business consultants, in that broad term, I include CPAs, lawyers, investment advisors, insurance people, all of those people, they're still living in the past and haven't caught up because they haven't heard the good stories about ESOPs. And so we're living with that. However, with the movement in the educational program, where MBA programs, like I said, the Darden School, Wharton
Mhm.
Management School at Rutgers, picking up employee ownership, and we're seeing a very significant movement over the last 2 or 3 years in government getting behind ESOPs even more than just being in the tax code. The current secretary of the Department of Labor that President Trump appointed a couple of months ago, she is very pro employee ownership. The undersecretary in charge of employee benefit plans, EBSA, within the Department of Labor, very pro employee benefit plans, focusing on employee ownership, on ESOPs. So we have people at the Department of Labor now that we did not have before, supplementing or adding to what's going on at the college level, at the more academic level, of bringing ESOPs into the discussion. It's really nice to be able to say, and I couldn't say this before, there's a continued movement, a continued bipartisan support. And you don't hear the word bipartisan
Hardly ever
used
these
in
days.
Washington today, unfortunately, but we're not going to get into politics.
No.
However, I can honestly say there is strong, strong bipartisan support for employee ownership at the federal level. As late as 2022, Secure Act 2.0 added tax benefits for ESOPs. So not only back 50 years ago, we got additional tax benefits as late as 2022. Between 23, 24, and 25, the last couple of years, Congress has allocated money to um, add employee ownership knowledge to the SBA, to the Department of Labor. So on a federal level, we're seeing continued money as well as just strong support from Congress. And now we're also seeing it on the state level. You may know Connecticut just actually within the last 2 or 3 years, Connecticut now has an employee and center for employee ownership. And we were fortunate enough, and I have been part of creating the Connecticut Center. We were fortunate enough to get a grant a couple of months ago. So we just within the last 60 days, we now have an executive director, part-time executive director, but we're moving in that
Excellent.
direction. There are over 25 states that over the last couple of years have created centers for employee ownership. So we're moving away from those myths, but they're still out there. ESOPs are too complicated. ESOPs, I won't get my money out. They're too expensive. There's too much liability. Believe me, I've heard all of those
It's
stories.
going to cause the
And
company to fail is my least favorite one.
so people ask me, why do ESOPs fail? Why do ESOPs go in and they fail? Or I heard a bad story. They did an ESOP and whatever. Without patting myself on the back too much, I've done a pretty good job, historically at least, in meeting these business owners over these last years, in meeting the business consultants who have those opinions over these last couple of years, and I think turning their mind around about ESOPs. The ESOP still may not be the right alternative for that particular situation or that particular owner. And like I said, ESOP is just one alternative. But I've had pretty good luck in at least getting people to open their mind as to what an ESOP is, what it can do for the owner,
Mhm.
what it can do for the company, ultimately what it can do for the employees. But it's still an uphill battle.
Absolutely. So the other thing that I've run across a lot is people are like, "Oh, I'm too small for an ESOP." So what are kind of the size parameters for a
Right. And
successful
certainly
ESOP?
another question that's out there all the time. And again, as I mentioned earlier, you might get a different opinion from different people on this. I'm going to share with you my opinion. The smallest ESOP I ever did was for a portion of a company that was worth $800,000, less than $1 million. That's pretty small, but the company went in with their eyes open and they were creating the ESOP so that not only a couple of their owners could sell. This company it was a professional services company, had over 20 owners, the way many architectural firms do or
Mhm.
engineering firms do. So they were setting up the ESOP so that the current group of people who were leaving, current group of partners that were leaving, could sell their shares to the ESOP, but also the ESOP would be there in the future. So $800,000 is a little small. I say that's a little small only because it does cost a couple $100,000 to put an ESOP transaction together. However, I would say almost any business that has a value of at least $1 million or $2 million. If you're going to sell that business, it's not cheap. Whether you bring in an investment advisor, whether you bring in an M&A professional, whether you just bring in your lawyers and your CPAs, it costs money to sell a
It does.
business. And I would argue that a couple 100,000, if a business is worth 5 million or 10 million, and the tax savings are as significant as we discussed a few minutes ago, the couple $100,000 that it does cost to put an ESOP together, is probably well worth it, at least in the right situation. So the short answer to your question is, I say, if a company has a value of at least $1.5 million or $2 million, it should an ESOP should at least be looked at, should at least be considered. To get nirvana tax benefits, to get that extreme level of tax benefits, that S corporation 100% ESOP, you do have to have close to 20 employees. And it's sort of, there's not a hard number, but there's a formula that has to be met. I have clients that have had 17 employees and met the requirements perfectly of being 100% ESOP owned. This company, was just one I'm thinking about, is up in Massachusetts, 17 employees. making millions of dollars a year and paying no income tax federally. And again, happened to be in Massachusetts, so just that
Right.
2.9% to Massachusetts. But I've done ESOPs for companies with 7 employees and that had a value of a couple $1 million. So it's only the cost of the ESOP. If the company is only worth $1 million, you probably don't want to spend 200,000 on selling it. But only because the cost of doing the transaction gets to be, at least in my opinion, maybe too high a percentage of the value of the business.
Well, and there's a going forward expense as well, right?
Yes, there is. And I'll say first, it's more than offset by the tax benefits. But yes, there is an ongoing cost. One of the requirements of doing an ESOP, not only at the time of the transaction, but ongoing into the future, is an independent valuation. Because we are playing with taxes, we are playing with the tax
Right.
code, because tax benefits, certainly take money out. Tax benefits that go to the transaction take money out of the coffers of the U.S. Treasury to make sure it's fair, to make sure things are not overvalued. There is a requirement of an independent valuation, like I said, for the transaction
Right.
and then annually thereafter.
Right.
So for a company, let's just use some very rough numbers. For a company that maybe has a value of $10 million, an annual valuation probably costs 12.5. It could be anywhere between 10 and 15,000. So I just picked 12.5 in the middle. So that is one ongoing cost. A second ongoing cost is you can do this internally. I do not recommend it. And that's just the record keeping. That's the
Yep.
TPA, the third party administrator you bring in when you have a 401k plan, when you have a profit sharing plan. Well, now you have an ESOP as one of your benefit plans. To do the record keeping, I always recommend an experienced TPA, an experienced third party administrator. So we already had 12.5, let's say, for the valuation company, for that maybe that $10 million company with 20, 30, 40 employees. The TPA cost is probably about $7,500 a year. So now we're up to $20,000 a year as the ongoing cost. The next cost to consider is a trustee. Every trust has a trustee, whether you set up a charitable trust, a trust for your children, a trust for your life insurance, you need a trustee. Well, an ESOP trust is a trust under state law. It needs a trustee. For the transaction, not legally required, but strongly recommended, we always bring in an external trustee, an independent trustee. However, once the transaction's closed, I would say about half of my clients stay with that external trustee. And of course, if you stay with that external trustee, that person, that company wants to be paid.
Right.
However, you can also go internal. And I have no problem with internal people at the company being the trustee or co-trustees of the ESOP going forward. So there may or may not be a cost there. But let's assume you stay with the external trustee. Again, for that $10 million company, that trustee fee is going to be between $12,000 and $15,000. Call it 12.5 again. So we're up to about $30,000. Those are the costs. That's the cost of maintaining an ESOP. You do have to have the valuation.
You have to have audited financials as well, right?
No, there is
No.
and that's another myth out there. There is no requirement for audited financials. I've done transactions where the trustees have accepted compiled financials, not even review level. As a former banker myself, as an ESOP lawyer, I strongly recommend review level, at least review level financial statements. Whether the company wants to have an audit, maybe they've already had audited statements, that's really up to the company, maybe up to the bank, if there's a bank involved in financing. Separate question, but there is nothing in the law that says a company needs to have audited financials. In fact, I would say less than 10% of the ESOP transactions I've done over the last 20 plus years have had audited financials.
Excellent. Well, I learned something new.
Yeah, always happy to share.
Every time I talk to you, Rick, I learn something new. So that's good. That's my nugget for today.
Okay.
We are running down on time. So I appreciate the time that you've spent with us. Is there anything else that we should consider if we're looking at an ESOP?
Well, I think the first thing is please have an open mind. And whether it's me or you bring in somebody else, and believe me, I'm not the only ESOP lawyer out there. I'll be the first one to say it. I'm not the only person out there that helps structure transactions. So we and my firm, and truthfully, because of my background in both banking, finance, operating a business, and now ESOPs, we will take the role of quarterbacking the entire transaction, or we'll just be the lawyer in the transaction if somebody else is putting the team together, putting the transaction together. But whether it's me or someone else, please talk to people who are experienced in ESOPs. There's more than me. I'll be the first one to say it, but there's not a lot of people in the country because the number of ESOPs is just not that great. There are not a lot of people who, as I like to say, live and breathe ESOPs 7 days a week, 24 hours a day. Have an open mind, get that business owner to at least consider the ESOP. Talk to me, talk to somebody else who's an expert about ESOPs. See if some of those myths can be dispelled. I certainly think they can. I think they are myths, but they are out there. I'll be the first one to admit they're out there. Have an open mind. As I said before, I honestly believe every time a liquidity event is being considered, the ESOP alternative, again, just an alternative, but it should be considered.
Well, thank you for your time, Rick. I have one more question for you. We end our program asking, if you had not been an attorney, what other job would you have chosen?
Oh, that's very, very interesting. As I jokingly say, I've had a very checkered career. Believe it or not, my undergraduate degree is in engineering.
Oh,
So I went from I have an undergrad degree in engineering, and I do have my JD, my legal degree. Probably if I was not an attorney, I'd probably have done something in engineering relating. And I don't think we've ever talked about this before, but I'm an avid boater. I love the water. I love living on the water. So I probably would have been designing sailboats or doing something like that.
excellent. We all have an entrepreneurial instinct inside of us. So that's interesting. Thank you so much for joining us on Touchstone Talks. Those of you that are listening, if you have not subscribed, liked, and followed Touchstone Talks, please take an opportunity to do so. And, Rick's contact information is on his page, and you'll be able to access it through Touchstone's website.
Thank you very much. It was a pleasure to be with you.
Thank you.